Hello and welcome. You're tuned into CNBC TV 18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos, and currencies. We will decode the global commodity narrative as it unfolds amid tariff fears and macro uncertainty. Joining us on the Big C today is Osama Rizvi, who is an energy and economic analyst at the Primary Vision. And later on in the show, we will also be joined by Aishwary Gupta, who's global head on payments at Polygon Labs. But before we deep dive into these conversations, let's take a quick look at the global market setup. The stocks on the Wall Street set or ended Wednesday's trading session on a very mixed note. The S&P 500 and Nasdaq Composite dipped, pressured by a broad decline in the tech names. Investors also weighed the mixed retail earning results and the Federal Reserve's latest meeting minutes release. All eyes now are going to be on the Fed Chairman Powell's speech at the Jackson Hole meeting. Meanwhile, the stocks in the Asian market mostly rose. China and South Korea stocks were higher, while Japan's Nikkei 225 traded 0.5% on the lower side. In South Korea, the Kospi index rose 1.1%, and back home, trading on the Dalal Street is taking a shape at the lunch hour, with Nifty trading well above the 25,000 mark. The stock sees small but broad-based gains, with gains far outstripping the losers. Well, looking at the crude oil prices then, and the prices did climb about 2% overnight. A bigger than expected weekly decline in U.S. crude and fuel inventories is pointing to a steady demand in that part of the world. Latest EIA data shows that the crude stockpiles fell by 6 million barrels to 420.7 million barrels last week, versus expectations of almost a 1.3 million barrel of a decline. Meanwhile, investors are closely monitoring steps in talks to end the Russia and Ukraine war, as any progress could influence sanctions on Russian crude exports and reshape the global supply dynamics. But as promised, Osama Rizvi, who is an energy and economist analyst at the Primary Vision, now joins us to take this conversation forward. Osama, hi, thank you so much for joining in. How are you looking at, first of all this conversation between US, Russia, Ukraine, with very, very different statements coming in from everywhere? Having said that, would you say that crude prices now seem to be getting slightly insensitive to all of this?
Well, thank you so much for having me once again. I would like to take it from there. I think the narrative right now, be it geopolitics, be it diplomacy, and including the markets, it's quite um, confusing. It's sending mixed signals, as you just said. We don't know what is going to be the future of a ceasefire, if there is any, between Russia and Ukraine. The recent Alaska summit was also can also be categorized as confusing or ambiguous, right? So there is a ambiguity amongst the markets. As such, the prices of the stock markets, the oil markets, they are at a point where they can go anywhere from this point. But as I said in the last show as well, I am still bearish on oil. Although it seems that the prices, oil prices specifically, are becoming insensitive or have become desensitized to the current happenings, there are certain indicators, macroeconomic indicators, that are going to manifest in the coming months and weeks, and which can shift the sentiment further on the bearish side.
I take your point well, Osama, when you say that you are bearish on crude oil prices. But what's your sense? How bearish are you, and where can the prices go from here? If you had the next 3 or 6 months in hand, how would you look at that trajectory?
Well, I'm going to make a very bold call, and this is just my personal opinion. I believe if we are to see a string of developments, such as a ceasefire between Russia and Ukraine, such as a ceasefire which has almost happened between Hamas and Israel, and if the tariffs don't go through and if the tariffs go through as planned, if they're imposed materially, I would say that we with oil prices would venture into the lower 50s. Now I know that this is quite a contrarian point of view, but when we look at the global demand indicators, we look at the global oil inventories. Actually, the recent oil market report by IEA shows that global oil inventories are at their 46-month high. Even though we have seen some drawdowns in Europe and US, oil on water seems to be swelling. So we need to look at the big picture, the whole complete picture. So yeah, I think it has the potential to go into the lower 50s. But for a balance point of view, I don't see them. I don't see oil prices going beyond 70, and there can be a spike maximum at 75, but that of course will be short-lived.
Osama, when you say lower 50s, are we talking almost a $10 of a decline from here, perhaps more?
Yeah, yeah, I would say that. I mean, 50 to 55. Basically, the major reason for that would be Russia. And if you look at the recent figures by Russian oil exports, they're slightly down in the previous 5 years. And given that they are facing a little bit of recessionary pressure as well, given the lower prices of oil, and the news has further been tightened around the price cap. I would say that if there is a ceasefire, we can expect more volumes coming out of Russia. We have seen this happening before, and now that the production quotas have been increased in OPEC Plus, although against the promise of 960,000 barrels per day between April and June, the group was only able to raise about 560,000 barrels, but that is still an increase. Interestingly, we have also seen some important development coming out of China. Last month, the allocations, Saudi allocations increased from 43 million barrels to 51. Now they have once again dropped to 41. And in October, they expect it to increase again. So there is a little bit of ambiguity here as well that what is going to happen from the largest consumer of oil. But Russia and Russian oil, I'm betting that if it comes into the market, we will see a drop of about $6 to $7 in oil prices as a war premium.
Well, that's of course about the geopolitics here, but when it comes to the Jackson Hole meeting, and clearly all eyes onto that one, ahead of that, we've seen a bit of a decline in the dollar index. We're also looking at support, of course, for various other high-yielding currencies at this point in time, but it's a choppy market at best. What are you anticipating from Jackson Hole, and what is your sense on how will that impact commodities, even currencies?
Well, it's going to be a very, very important announcement, of course, and we would be closely following the language and the tone of the address. But when we run some numbers, when we look at the U.S. economy right now, you find a lot of issues. For instance, look at the labor markets. It's very important to see where are we anticipating the next job report for August. And if we look at the number of hours worked, they are flat. If you look at continuing claims, they are still on the rise, 1.97 million barrels, 1.97 million. So I think we are expecting anywhere between 80 to 90,000 figure once again, and that would be two in a row. The SARM's rule has also been triggered since the last job report. We look at manufacturing, it is down 48. We look at Conference Board's leading economic index, it is also down. Now, there is some positivity amongst consumers, and I think that the Jackson Hole meeting is going to showcase that. But majority of the indicators are down, so I think it's going to be a very balanced, a speech with the acknowledgement and with the realization that there are some flashing red signals in the economy, hence a delay in further cuts by the Fed.
Osama, there's two ways to look at it. This is the last speech that Powell perhaps would be making, and either he's going to be non-committal because it's the last one, or he could perhaps pack a punch. What side are you looking?
I think it's going to be. I think it's going to be once again keeping in line with the global narrative right now. It has to be somewhere in the middle. I'm not looking for a surprise. I'm not looking for a shock factor. It will be there. There can be at least one Fed cut, a rate cut this year, but not more than that. And I think once again, to repeat and to stress upon the point, I think that he is a man of numbers. He has always gotten the numbers right. So he is going to acknowledge the fact that there is some underlying weakness in the economy, but at the same time, he's going to take into account the tariff threats and the geopolitical flashpoints that still remain in place. So you see, even the narrative is as such that there has to be a middle way. We can't go on one side, especially during these times.
Fair point that. The other thing, of course, as you've been mentioning, is tariffs and Chinese demand and the sanctions on India therein. This is something that you'll have to see in the same light as of While we do anticipate that the crude oil supplies are enough and in surplus, by the way, how do you see demand panning out?
Well, I think the demand for oil from India would be, um, if you look at the recent, estimates, the Asian demand, excluding China, the second highest is going to be from India. Not only India, but also what are called the Tiger Cubs economies like Maldives or like Philippines, Indonesia, and others as such. So, I mean, at this point, it's not purely about demand; it's also about the supplies. We need to realize, or we need to take into account the fact that there might be further pressure on India to buy in continuation of buying oil from Russia. So, what are the alternatives? Iraq comes out as a very interesting alternative. They have increased their infrastructure capabilities. They intend to produce 6 million barrels per day by 2028. The Basra oil terminal has also improved. So, and already it is the second largest, if I'm not mistaken, supplier of oil uh, after Russia to India. So, demand looks strong. Dollar and interest rates is going to weigh down on this. But so far, I think Asian demand has held better than its West counterparts.
Mm. It's not just about the crude prices, it's also about the crude products, which also have seen quite a sharp decline. So whether it's heating oil, natural gas, gasoline, those prices haven't picked up much as well. Are we looking at, I mean, we are down 10% for the crude oil prices in 2025 till time. Is that how we're going to close this year? Much lower, as you said. But is that the case going to be for the crude products also?
Well, that's very interesting, and this also fits neatly with what I've said before. As you mentioned, we haven't seen much spikes in products, which also cements or corroborates the fact that the demand has not been as strong. When we look at especially the gasoline prices and the summer driving season in the US, when we look at the spending in restaurants, once again the consumer side comes to the surface. It hasn't been that strong. Secondly, we that being said, we have seen some sort of tightness on the product sides. We look at ARA recently, there were some product drawdowns. We look at other Fujera stocks were 17 weeks or something like this low. But at the same time, I'm anticipating a further slowdown. Hence, I would say that the product markets are going to ease, the tightness is going to end, and the prices will remain range bound at best with more potential towards downside.
All right. Thank you so much, Osama, for joining in today. So bearish on crude oil prices can go to $50 to $55 a barrel as well going forward. Of course, that is if the markets continue the way they are at this point in time. One rate cut from the U.S. markets or the U.S. Fed in 2025 is something that we'll have to work with. But most importantly, as said, it is going to be about the Jackson Hole meeting, and the kind of statements we get from there will impact asset classes across. Thank you so much for your time today with us. But with that, we'll slip into a very short break. On the other side, though, we will be joined by Aishwary Gupta, who's Global Head of Payments at Polygon Labs, to discuss all things crypto. Stay tuned. Welcome back. You're watching The Big C on CNBC TV 18 Prime. We are now joined by Aishwary Gupta, who is the head of payments rather on Polygon Labs. Aishwary, hi. Sorry, used to saying that a lot though. But what is your sense really with the way we're looking at the crypto markets right now? You know, when you look back, 2017 was all about FOMO perhaps from the retail buyers. But 2025 is a very different market. There is repositioning that we've seen happen from high net worth individuals, institutions, companies perhaps. How do you look at this year until time?
I mean, absolutely. I think 2018, 2019 was more retail. This time it is more institutional from the way like the things are coming in. Like a lot of people in the US side actually going out and acquiring a lot of assets from the crypto world. They're going out and taking big positions. It's not just US. I think globally a lot more markets have started opening up. Like I think last week only we saw like the state of Wyoming actually going out and making their stablecoin live on blockchains. So that has been like really kind of a major shift that has been seen where on one side like the governments were like very apprehensive about what will happen with crypto. Is this something that is a mature market? There was a clear demarcation on how they want to adopt it. But now I think like more and more of these things are getting opened up. There are a lot of like conversations happening across the world with the governments also where like a lot of adoptions, a lot of ways in which like the governments can actually go out and use or like start using the technology as well as get into the market is something which is like drastically happening. And I mean, a lot of funds effectively are also actually starting to allocate at least 1 to 2% of their total AUM that they are going out and making like that they have. Even from the perspective of, I think, like the biggest funds which are there, they've also started looking at like blockchain as a distribution mechanism. So if you look at like major names like BlackRock, Hamilton Lane, Apollo Credit, and all these other major funds, they're deploying their funds on like blockchains like Polygon and all the other chains. And effectively, like they're going out and seeing more and more traction for their existing product on blockchain as well. So overall, I think now it's becoming more of an institutional play as compared to 2018, where it was more of a retail play.
Oh, well, yes. Aishwary, I was reading statements from President Donald Trump's son, Eric Trump, yesterday at Jackson Hole, where he says that he's a Bitcoin maxi, is one thing that he said. And then he says 50% of time goes on crypto projects, and that crypto asset will be worth $175,000 by the end of 2025. He's, of course, talking about Bitcoin there. How would you look at all of these statements? I mean, as we say, there are people in position who are now talking, advocating cryptocurrencies, blockchain even, and that has brought in more credibility, would you say?
I mean, the one thing that has happened this year majorly is that a massive amount of liquidity actually started coming and flowing in. And that has been because a lot of instruments that were available on the Wall Street have actually opened up to crypto. So like like earlier, there was only like a limited number of companies like Grayscale or like Sailor who was like kind of going out and making all the purchases. But now what is happening is like with coming of the ETFs and also like all these other treasury companies or digital asset treasury companies which are happening in the US and globally as well. Like I think the biggest thing is like all there is a massive amount of demand that is coming in, and like because of that, even states, like it's not just like these Wall Street companies, it's even like the governments have started actually taking positions in Bitcoin. So I mean, from the hypothesis that Bitcoin has only maximum 21 million tokens, you have to understand that if the demand is increasing, there is like only natural that the price will have a positive impact because of that.
Mm. The other buzzword clearly has been tokenization, and that really seems to be picking up, not just in Dubai, but various other countries as well. With the market cap at around, or the overall market at around $25, $26 billion, the outlook clearly is being put out as very, very bullish. From many multi-billion to trillion dollars of a market is what people are anticipating it to be by the time we are at 2030, etc. What are you at Polygon looking at? How are you onboarding this? What kind of projects, partnerships are happening here?
I mean, absolutely. The way I look at it is like all these funds, like I think earlier also mentioned, all these bigger funds which are like BlackRock. BlackRock is there, Hamilton Lane is there, Apollo's Acred Fund is there. So all these are like kind of opening up. There are a lot more names that are in the works which are launching their funds on chain, which ranges from money market funds, AAA CLO bonds, like overall fully bonds. Like in Europe, I think on Polygon we have around four banks which have issued around 400 million euros worth of bonds individually, like and like among them like NRW Bank, Siemens, all these are like big banks which effectively have already done that. In Japan also, I think last year we saw like Sony actually going out and issuing green bonds on Polygon. So from that perspective, like a lot of those big names are actually coming in and they are actually issuing their funds and assets on chain. And like when you talk about just not this one, like so bonds, funds, even private credit, a lot of private credit is actually coming in. So we are seeing like a couple of asset managers that we are talking to, which hold assets in trillions. They want to come in and they want to actually get into the blockchain space. They want to tokenize their entire AUM that they have. So you're not just talking about billions. Like a lot of people are actually going out and doing that, and rightly so, because effectively, like the way you look at the current way the funds are structured, like if you talk about private credit, it's almost impossible to access for anyone like who isn't an accredited investor or doesn't hold a massive amount of wealth. So that hurdle to get into is getting lower. You can get into like private credit funds in less than like $5,000, which was like a very big thing earlier. So effectively that is also triggering a lot of those funds or a lot of new entrants into the market to actually go out and start investing. Even tokenized stocks is another thing. Like a lot of tokenized stocks have started coming on chain, like Apple, Tesla, and all these major companies, and they're also like slowly the demand. I think the market is still maturing there, but slowly the demand would kind of come in if the efficiencies are there, because blockchain is not just not offering tokenization. It's effectively enabling you to kind of go out and go to a particular user set which was not privy to this, which enables you to amass like more AUM. It is also enabling more utility to it. So, like from your perspective, like I think on Polygon we have this Apollo Credit Fund, and you can actually go out and use that as a collateral to borrow stable coins, and you can actually leverage and loop it on the blockchain. So effectively, like the naked fund would give you somewhere around 8%. But like if you kind of go out on Polygon and loop it, you effectively can from the same fund get somewhere around 12 to 15%. So I mean that is also actually adding a lot of efficiencies and a lot of return that effectively was not available or possible earlier as well.
Well, I get that. Aishwary, all the derivatives that the street is looking at right now, and with the way we've seen institutions get into it, would you say retail, in some sense, is still getting aware or learning about just about investing in cryptos? The yielding, staking, and ensuring and trading in derivatives is something that we've seen very less exposure from.
Yeah, absolutely. I think from a retail perspective, the participation as compared to how it was in 2021 is kind of lower. Like the way I look at it is like, I think in the morning only I was reading a report which says the amount of retail inflow versus the institutional inflow is like retail is around 5 to 6% right now, and the institutional flow is somewhere around 95%. So that is something which has happened, and rightly so, because effectively a lot of people have just thought about crypto initially as a quick to get rich scheme, and they have lost more money than they have actually gained. And that's why like those effects in their mind are still there. They're looking at more regulations to come in to actually get back into the market so that they can understand whether they have some protections from the government or from the regulatory bodies to be able to kind of go out and increase that. So I would say like they know about it. It's not that crypto is no like not a thing that they don't understand. It's more like they're being cautious because of the ways earlier like they have kind of burned themselves without like by trying to get rich quick and like and ultimately losing the principal also.
Well, that's an interesting number that you've thrown at us, that the retail participation is just about 5 to 6%, while the institutional clearly has gained up to 95% as of now, quite contrary to what we saw in 2017-18, perhaps. Aishwary, thank you so much, as always, for joining in and making sense of what really is happening in the crypto markets at this point in time. We hope to speak to you very soon yet again. But as of now, this is wrap on this episode of Big C. Thank you for watching.